Hi everyone, this is Josh at Checkmate. We're going to get started on this afternoon's webinar here in about a minute. So I'll just give a minute for everyone to get logged in and we'll get started. Thanks everyone for joining us. All right, I'm going to get started. We'll let the others who are logging in here will, well, hopefully they won't miss much. So let's see. I now need to hide my camera and share my screen. Okay, sorry about that, everybody. I had a little bit of technical difficulties, but we are good to go now. So here we go. I have a lot to cover. We've got an hour and a half set aside. I'm going to make sure that there's at least why is my PowerPoint not that there's at least half an hour for Q&A. If not, hopefully a little bit more. I need to now figure out why it didn't work. And before I dive in, there's a Q&A section here. This is the second or third GoToWebinar I've done. There is a Q&A section here. Please start posting questions in the Q&A section as they occur to you. I do have a few that were sent to me ahead of time that I'm going to cover near the beginning here. But for right now, just please, in order to make sure that we at least capture the questions that you have, and you know, even if I don't get to them on today's webinar, it will give me an opportunity to make sure that you get a response to those questions one way or another. Okay, so now I just need to check one more thing. Okay, now everybody can see what I want you to see. Here we go. And this one, if your head isn't already spinning from the stuff I've covered before, you know, apologize in advance. This is going to be a bit of a head spinner for you. However, it is stuff that everybody needs to know about, especially, oh, wait a minute. Why is this not? Why did it do that? Okay, so I'm going to show you another screen. There we go. I think that is good now. All right. Okay, so before diving into the actual meat of what I have to cover today, which is PPP loan forgiveness, and I have a very elaborate spreadsheet that you're going to watch as I show you how to determine how much of your PPP loan can be forgiven. However, before I jump into that, I do want to put it out there. If there is anybody on the call who has not yet had your PPP loan application submitted, and you are looking for assistance or guidance on anything to do with that, please do let me know, and I'm more than happy to help you out. It just occurred to me that I don't have my earpiece on, and I'm hoping everybody can hear me all right. It never even occurred to me, but it seems to be picking up my voice all right. So, okay. So there's an elaborate spreadsheet we're going to go into. I'm going to show you how to determine how much of your loan can be forgiven, so that you can start making executive decisions around what you're going to do if there's an amount that right now you are not in a position to have forgiven. And again, if there's anybody out there that doesn't have their application submitted yet, that's looking for guidance, or if you have your application submitted and you are in any way, shape, or form in need of some direct support in relation to what's going on here, I'm more than happy to find some time to talk, possibly tomorrow, possibly Friday, but do please let me know, because it's very, very important right now, from my perspective, that everybody has the resources that they need in order to be able to make sure that you get what you're due in the form of the PPP loan, in order for all of our businesses to ultimately survive this crisis. One of the things I wanted to mention as part of this intro of what's happened so far, as I've mentioned on a number of webinars so far, these things are changing on a daily basis. I think yesterday was the first time that I was able to tell my team, we have a 4 o'clock check-in call. I was able to tell my team that I actually didn't have specific news about what has changed lately yesterday, but I had some on Monday. And this is in relation to the employer Social Security tax deferral option. Late last week, I think on Friday, the IRS posted FAQs on their website in regard to the PPP loan program, and specifically in regard to the employer Social Security tax deferral option. And it is now very, very clear that all employers, it doesn't matter how many employees you have, doesn't matter, there are no conditions here. All employers can defer the employer side of the Social Security tax cost from 3/27/2020 through 12/31/2020, or the day on which your PPP loan is forgiven. So the employer Social Security tax deferral option is no longer exclusively for those that did not apply for a PPP loan. You can take advantage of this now. And the forgiveness, we have to get through 6/30/2020 before you can apply for forgiveness with your lender. And the lender then has 60 days to assess what you have submitted and determine whether or not your loan can be forgiven. So that brings us from 6:30 to 7:30 to 8:30. So you are looking at, potentially being able to defer your Social Security payroll tax on the employer side until late summer, from this point until late summer. Now, everybody who's on this call should have received an email from us earlier today. It's one of the latest client emails about the CARES Act, FFCRA, and coronavirus crisis. And in that email, there's a link to a web form for you to sign up for the employer Social Security tax deferral service. And in order for us to defer your Social Security tax, we need for you to complete that form and submit it. And once we receive that, we will begin deferring your Social Security tax costs. I needed to start off by sharing that quickly before we dive into the meat of the presentation today. Given what I gave this presentation earlier today to the UNH Center for Family Enterprise, and given how that went and the questions that were coming up, I'm actually, for right now, in the email that went out today, there are details about how our employer Social Security tax deferral service works. And those details are also on that web form. I am not going to be spending much of any time beyond what I've just said, talking about the employer Social Security tax deferral option during my presentation. However, if there are Q&A questions about it, I will speak to it then. And the employee retention tax credit, I'm also going to not spend a lot of time on this afternoon because the details that I need to go through with the PPP forgiveness and the spreadsheet are very, they're very intricate, and I want to take the time. I don't want to rush through it, and I want to still make sure that there's plenty of time for Q&A. So I do apologize for those who were on this webinar exclusively for those 2 items. And if you are on the webinar for those 2 items only, if you were to shoot me a chat message in this webinar or send me an email, I will call you sometime in the next day or 2 so that I can talk to you specifically and directly about the employer Social Security tax deferral details and the employee retention tax credit. I am planning to write up what I would have otherwise covered in this webinar on these topics and share them with you. Probably that probably won't get out until the weekend, but I will speak to anybody who wants a direct conversation about this as well, since I'm not going to cover it like I had planned in the webinar today. So I'm going to breeze through these because everybody's going to get a copy of this PowerPoint. But these first few slides are basically what I've been covered in the first CARES Act webinar, which is basically just the premise of how the Paycheck Protection Program works. And I don't want to waste their time going through those details. For those that need this information, you will get a copy of this PowerPoint. And again, it is pretty clearly laid out in the PowerPoint what these details are. And again, that if these details are important to you, that would put you in the group of folks that haven't applied for your PPP loan yet. And again, I do want you to know that I'm happy and more than happy to help you with whatever you need directly, offline, not part of the webinar. So this is where we get into the meat of our presentation. So once we have secured our Paycheck Protection Program, how does this work? What do we need to know? And the first thing that we need to think about are what are the legitimate and forgivable uses for the loan proceeds? So payroll costs are again, one of the key items here. The costs related to the continuation of group health benefits. And this includes, for the group health care benefits, this includes employer contributions to group health insurance, employer contributions to medical FSAs, employer contributions to health savings accounts, employer contributions to HRA accounts. All of those are healthcare related employer costs, and your money from the loan can be used for those. Employee salaries, commissions, or similar compensations, payment of interest on any mortgage obligation, which does not include the prepayment or payment payment of principal on a mortgage obligation, rent, and utilities, and then interest on any other debt obligations that were incurred before the covered period. So how does forgiveness work? And there's a lot of technical details in these couple slides here. It's a lot of IRS language. I will translate for you. What this says is the forgiven amount will be equal to the amount actually paid for payroll costs, salaries, benefits, rent, utilities, and mortgage interest during the 8 weeks following disbursement of the loan. That is a key phrase to understand. Following disbursement of the loan. What this means is from the date on which you receive your funding, the 8-week period starts, and you have 8 weeks to spend that money. Any monies that are not spent after 8 weeks will not be forgiven. At least that's how the rules seem to work right now. So the additional wages paid to employees under the Standards Act may also be forgiven. This basically is saying that the forgiven amount will be the amount equal to the gross payroll, gross payroll costs, plus the cost of employer cost on benefits, rent, utilities, mortgage. And when I say gross payroll costs, I am not including employer taxes. Gross payroll costs in this context does include, so technically, employee Social Security and Medicare taxes. You can include employer Social Security and Medicare taxes. So when I say gross payroll cost, what I technically really mean is the total cost of payroll, including the employee Social Security and Medicare contributions, but not the employer. That's usually what I mean when I say gross payroll cost. In this context, it simply means what I just said, except swap the employee Social Security and Medicare tax with the employer Social Security and Medicare tax, which is more or less a wash anyway, because the numbers are the same. With the exception of wages that are paid under FFCRA, of course, because there's different taxation on the employer side of Social Security for that. The forgiveness amount is subject to reduction if there is a workforce reduction or a reduction in the salary or wages of an employee. That's also a key phrase. Or a reduction in the salary or wages of an employee, not of all employees on average. It's of an employee. And there are so many questions that issue raises that I don't know the answers to right now. For instance, what if the employee was there during the on 2/15/2020 and then we had to do a layoff, and then either they chose not to come back or we chose not to hire them back. That is a very big question about how the presence or rather the absence of the employee on your payroll at the end of your 8 weeks will actually impact this rule. And that still is to be determined. But the point of today's webinar, when I get into the spreadsheet, is to show you what we do know so that you can start making your decisions on what we do know, knowing that there's a bunch of things that we still don't know, and keeping yourself apprised of the communications coming from Checkmate. We will be keeping you updated as more and more of these details come to light. We are just waiting on additional guidance from the IRS on all of these things that apparently nobody thought of. So other details for loan forgiveness, and this backwards. Okay, there we go. So the amount attributable to a workforce reduction will, and again, this is the part that's going to make your head spin. I will explain it in the spreadsheet. The spreadsheet has all sorts of formulas, and everybody who's on this call will get a copy of the spreadsheet with the formulas in it so that you can do with it whatever you need to make it work for your situation. The amount attributable to a workforce reduction will be equal to the initial forgiven amount multiplied by the quotient of average FTEs during the 8-week period divided by the average FTEs for either the period from 2/15/19 to 6/30/19 or from 1/1/20 to 2/29/20. And you get to choose which of those two timeframes. And the spreadsheet will help you figure that out. You'll see this in a few minutes. The amount attributable to a salary or wage reduction will be the amount of any salary or wage decrease in excess of 25% of the total salary or wages during the most recent full quarter such employee was employed for the 8-week period. What this is saying is that the annualized wages that you pay over your 8-week span once you have your loan money cannot come out to less than 75% of the annualized wages that the employee earned during the most recent full calendar quarter, which for most of us will be Q1, if the amount that the employee earns over the 8 weeks after you get your loan comes out to less than 75% of the annualized amount that they had earned during Q1, then some of the amount of your loan will not be forgiven, and this spreadsheet will help you make that determination. And again, we're talking about an 8-week period that hasn't happened. So the whole idea with the spreadsheet is you can use this spreadsheet to speculate what your payroll costs will look like over the 8 weeks once your loan is funded, to help you today to figure out how much of that loan amount you can expect to get forgiven. Because one of the things that you're going to see when I get into the spreadsheet is, once you build out or do all the math, many of us are going to be in a position where we are receiving more loan money then we would, if we just went with our standard plans that are already in place or that we think will be in place, we will not spend all of that money. So there will be some of that money that wouldn't be forgiven, and that puts us in a position where we can strategize around. Okay, well, right now I'm lined up for $40,000 to not be forgiven. Okay, well, what could I do with that money between now and the 8 weeks, the end of the 8 weeks, in order to get that $40,000 forgiven? You could give people raises, you could hire people, you could fund everybody's retirement accounts. There's all sorts of things that you can do with that money. If you know that you're going to have excess funds beyond what was part of the loan, which is the whole point of today's presentation, put you in the position where you can start to make these decisions. So only employees who did not receive during any single pay period during 2019 wages or salary at an annualized rate of pay in excess of $100,000 are included in this calculation. What this sentence means is that if you reduce the wage of somebody who earns $150,000 in the previous calendar quarter more than 25%, you are not going to get a penalty. That won't have a negative impact on your forgiveness. So they're basically saying that it's okay, to knock someone's salary down more than 25% if they were earning in excess of 100,000. But you're going to want to, so in essence, anybody earning $100,000 a year annualized during the 8-week span that you have your PPP loan to fund your payroll, you can lower their salary by as much as down to as low as $75,000 annualized and not have a forgiveness problem with your loan. So reductions in workforce salaries and wages that occur from 2/15/20 to 4/26/20 will be disregarded for purposes of reducing the forgiveness amount, so long as the reductions are eliminated by 6/30/20. You're going to see in the spreadsheet that the spreadsheet attempts to help you figure this piece out as well. Not just attempts, it actually does help you figure this piece out as well, as far as your reductions in the workforce between 2/15/20 and 4/26/20. What this means is that if you were in a position where you had to lay folks off during this span of time, 2/15/20 to 4/26/20, because keep in mind, or I don't think I said this yet, but there is your initial FTE count that we are going to compare your total FTEs at the end of the 8 weeks against, or your total FTEs as of 6/30 against, is an FTE count of your workforce as of 2/15. So if you had turnover, if you did layoffs, or you otherwise had to let people go between 2/15/20 and 4/26/20, this will not have a negative impact on your forgiveness just because they were not employed, as long as you bring them back by 6/30/2020. And yes, this does, if you were to think creatively about this does mean that there are certain contexts in which you might have received a PPP loan for a significant amount of money, and you could still potentially get all of it forgiven if you hire everyone back on June 30th. There's no, that in some cases could be a way to get 100% of your loan forgiven. But again, some of this I think is going to be cleared up with some future guidance as there is more time for folks to actually realize that there is so much such a lack of clarity around so many things. On that note, just to bring up another item, so the 6/30 date is an arbitrary date that's put into the legislation. That is basically, somehow, some way, somebody came up with the idea that the 6/30 date was going to be the date on which they would have you required to have staffed back up and still be able to get your loan forgiven. It's also interesting because 6/30 is the deadline. It's the last date, theoretically speaking, on which PPP loans can be submitted for approval, which doesn't make any sense if it's if it's also the date on which you have to have restored your workforce. So again, guys, you know, I can explain as much as makes sense. I can't explain the stuff that doesn't make sense. There's a lot of absurdity here. So once 6/30 rolls around, you must apply for forgiveness with the lender. The lender has 60 days to review, and any portion of the loan that is forgiven is not going to be considered income to the company. It is basically going to be considered just like a loan. You know, it's funding. It funds your bank account, but it is not something that you actually recognize on your books as gross income. Therefore, you don't pay you know, corporate tax on the amount of the forgiven loan. So now for our loan forgiveness calculator. And like I said, everybody here is going to get a copy of this. I'm going to talk you through what this spreadsheet is doing. There's many pieces to it. And I'm actually, before I get into that, I am going to touch on a few of the questions that were submitted ahead of time here before I dive into the intricate details of what the spreadsheet's doing. Okay, so I'm just going to kind of read a few questions just to answer them, you know, one by one here. So the first question is, does the 75% of the loan include the expenses such as mortgage, interest, utilities? Yes. Well, so no, the 75% of the loan doesn't include those. Those are costs that you're able to use the loan proceeds for, but you can't spend more than 25% of the total loan amount on mortgage, interest, utilities, or rent. Then there's another question here in regard to what can be paid for as a legitimate payroll cost. The comment here says that we pay 100% of life insurance, 50% long-term and short-term disability. Is this something we can use for the 75%? And the answer is no. You cannot use the PPP loan money to fund the employer benefit cost for any benefits other than benefits related to health insurance or retirement. Let's see, then we have, okay, so this is an interesting question. We have earned vacation and sick time carried over from 2019. We always pay in the following year, but no set time, just when we have the funds. Usually it's around this time of year. Can we pay the employees this and include in the 75%? And yes, the answer is yes. Basically, you can, when we're talking about how much we're paying employees and having that part of the 75%, a couple of things. First of all, at the 75% number, the rule is that your money, your PPP loan money must be spent, at least 75% of it must be spent on payroll. There is no downside to spending more than 75% on payroll. Secondly, the payroll cost here, you're talking about issuing a payout on paid time off. There are no rules that I have come across that actually stipulate which types of earnings are going to be counted when we're calculating the wage reduction threshold or any of that in order to determine forgiveness here. So you can pay bonuses, you can pay paid time off payouts, you can pay commissions, you can, as long as they're commissions to W-2 employees. You know, all of those things can be paid with the loan. So the next question here is, it's an employee benefit. Oh yeah, if it's an employee benefit, would it be construed as a bonus and not eligible? Bonuses are eligible. Then there are 3 producers we pay but not through payroll. We 1099 them. Is their commission payment eligible? And to my knowledge, the payment of your 1099 contractors, your sounds like outside salespeople, to my knowledge, the payment of 1099 wages is not, I know that it's not an acceptable cost for you to have accounted for in the determination of your PPP loan amount. And because all 1099s were able to get their own PPP loans, I'm pretty sure that you are not able to pay 1099 contractors with proceeds from your PPP loan. Then it appears that we cannot use the loan for the employee-employer portion of Social Security and Medicare. And I want to correct that. The loan money can be used. The loan money can be used to pay. So the loan money basically the loan calculation, the calculation you went through to get your principal amount included gross payroll costs, which includes the employee Social Security and Medicare tax. It is totally appropriate for you to pay the employer Social Security and Medicare tax with the loan money, and the employee and so you can pay one side of the Social Security and Medicare tax with the loan money, but not the other side. It's really semantics to say whether it's the employee or the employer side. So you can use the loan proceeds to pay one side of it, but not the other. What about federal tax? No, you cannot use the loan proceeds to pay your employees federal income tax. However, the loan principal, the employee is going to pay their own federal income tax, through the paycheck. So it's not you using your loan money to pay the federal income tax. It's you using your loan money to pay the gross payroll, and that does include the income tax that the employee is having withheld from their paycheck. But it is not the employer paying income tax on behalf of the employee. It's just the employer forwarding the income tax money to the IRS. So I just want to clarify that you're using the loan money to fund your gross payroll costs, which by its nature has the income tax money in it. But you are not using the loan money to pay your employees' income tax liability. They're using their own paycheck money to pay their income tax liability, and it's just happening through payroll deduction. So it is not true to make the statement that you can use this money to pay the people. You can use this money to pay your gross payroll and withhold their income tax as normal and forward that to the IRS. But you are not funding their income tax liability. You cannot do that with this loan money. So let's see. And then there's detailed questions. Again, the loan money can be used for the purposes of payroll, for the gross payroll costs, plus the employer costs for SUTA, plus the employer costs for local and state tax liabilities that you as the employer pay 100%. Plus the cost of the retirement or the employer contribution to the retirement plan, plus the employer costs for health insurance, and anything related to the health insurance. As I said, those can all be included in what you pay for with this loan. But you cannot use this loan money to pay for voluntary life. You cannot use this loan money. I mean, technically that would usually be a deduction from an employee's pay anyway. So you cannot use this loan money to pay an employer portion of short-term or long-term disability. You cannot use this loan money to pay an employer portion of life insurance or an employer portion of any other benefit other than retirement and health insurance. So now to the spreadsheet. So the spreadsheet is designed to calculate your forgiveness amount. And as you probably understand from what I just zipped through with this presentation, there's a lot of details to this. The spreadsheet has multiple tabs. Everybody that's on this call will get a copy of this. I will try to get this in everybody's inbox by tomorrow morning. These cells here, some of these cells are referring to fields that are in the other tabs and whatnot. I'm going to, a couple of caveats with the spreadsheet. One, I didn't invent it. I obtained it from another source and I made it into what it is now. It is not a fully refined and final draft product. It is what I used to do my own analysis for Checkmate's PPP loan. And I do believe, having worked through it like that and made it nicer looking and cleaning it up in some areas, I do believe that it can be effectively used for your purposes as well. But I do need you to understand that this does not have a user guide with it. And I also need you to understand that there's formula logic that's in the spreadsheet that is all based on the rules as I understand them to exist today. And so, if there's any changes that happen that have already happened that I don't know about, or changes that happen tomorrow or sometime in the future, the spreadsheet isn't going to be 100% relevant, based on those types of changes. I am, staying fully apprised of all such changes as well, and my intention is to, to take these concepts that are mapped out or actually completely working within the spreadsheet, and sometime next week or the week after, I'm going to try to figure out to what extent I can actually put this functionality in your Kronos accounts to give you access to something like this, on a payroll by payroll basis, rather than leaving you just to fill in the spreadsheet as the weeks go by. But worst case scenario, the spreadsheet is better than nothing. So that all said, I'm also, I hope everybody has understood, but the caveat that I was just giving really was meant to say, this is a disclaimer. I do not assure you or promise you 100% of anything to do with this spreadsheet. The decisions that you start to make based off of the numbers that you see in the spreadsheet, I'm giving you my knowledge to the best of my ability. But because of the nature of the animal that we're talking about here, I just simply cannot offer any assurances that that the decisions that you start to make based off of the spreadsheet will be, accurate and valid decisions once we get through the weeks of the loan period, and we're now looking backwards at what happened. But I do believe that if you follow the concepts of the spreadsheet, and if you follow what I'm about to show you, and use it to the best of your ability, I do believe that you are going to have a very good sense of how much of your loan you can expect to be forgiven, and that should be able to position you to make some decisions around this. That said, once you use this spreadsheet, populate it with your own info, and have determined how much loan forgiveness you can expect to receive. If there's anybody that needs additional guidance or wants some input from me on what your forgiveness spreadsheet looks like, then do send me a copy of the spreadsheet to covid19@checkmatepayroll.com, and I will look at it, and I will do my best to respond as quickly as possible to that request. So this all said, I'm going to walk you now through our spreadsheet. So the first item, of course, up at the top is the total loan amount. Now, the second item here, as you can see, there are many cells that are drawing data from other parts of the system, or rather the spreadsheet, including, so most of the ones that are in yellow, you don't need to do manual entry into. And so with each of these, when you key into the cell, this shows us, okay, so this number 124,996.56 is coming from the estimated payroll info tab. So we go over to the estimated payroll info tab, and what we see here is this is my calculation, and this is an example, but this is my calculation of what I was anticipating for each of the pay periods, the weekly pay periods. And I know some of you are bi-weekly, so some of your numbers, you'll only have 4 rows where I have 8. The gist of this is looking at what we have recently had for numbers for total hours and recent payrolls, and looking forward into the next 8 weeks. I speculated that we were going to have total hours, and this is total work hours of what you see here, for a total across all 8 weeks of 4645.36. The gross payroll cost I estimated as well, which is based on some averages and whatnot. And again, this is forecasting into the future, so this is a best guess kind of effort. But then I have my sum of total payroll costs, gross payroll costs, for the 8-week span. And then I calculate here in column D the total amount of the wages that are included in the gross payroll costs that are representative of annualized pay that exceeds $100,000 a year. And in this case, that's $626.92 per week of wage that is earned, that is representative of the excess over 100,000. So we then calculate that total, and then down below we have our averages here. So we calculate the average amount of hours worked across the 8-week span for our employees. And then this is used to determine an FTE count, okay? And this is where the FTE comparison of how many FTEs did you have on staff as of 2/15 versus how many FTEs did you have on staff as of 6/30. That's why I have this here. So the FTE calculation takes your total hours worked and it divides it by a value here that's over on the FTE spreadsheet. But in the context of the CARES Act and the PPP loan forgiveness, the concept of a full-time equivalent employee follows the ACA. So a full-time equivalent employee is any employee that works on average over 30 hours per week. So in order to come out with our FTE count, we take our total hours, 580.67, divided by 30, which gives us 19.355. Then below, on the same tab of the spreadsheet, I have documented the weekly cost of health insurance, the weekly cost of the 401k, the employer contribution to the 401k, because keep in mind, your employee's contribution is part of the gross pay. And then I didn't put it here yet, the state UI, would also be listed here. And then we come up with a sum total of our health insurance and our 401k. And then when we sum it all up, we end up with our total payroll costs after having subtracted out those costs that represent annualized wages over 100,000. So back over here, we have our actual PPP loan amount. We have the total anticipated payroll costs based on my current reality. And these numbers I changed most of these numbers, but I didn't change them all. So again, the gist of this is that based on the current reality of our situation, or based on, without thinking about increasing people's rate of pay, without thinking about hiring new people, to grow our company, or perhaps, we are speculating on what is the reasonable thing for us to calculate here for payroll costs and related costs over the span of the 8 weeks. And then, theoretically speaking, once we account for our, not theoretically speaking, actually speaking, once we account for the other costs that we can legitimately use this money for, then we have the sum total of all planned expenses that we might use this loan money for. And then the difference being the amount that if we don't spend it, find a way to spend it on a forgivable reason, for a forgivable reason, then we will have to pay back at a 1% interest rate. So this now puts us in a position where, all else being equal, we can now sit here and think about, okay, so I got $50,000 of PPP loan money, and I either need to find a way to use that money in a way that will make it forgivable, or I need to be prepared to pay an interest rate on that money, or I need to be prepared to pay back this amount in one fell swoop immediately upon confirmation that it can't be forgiven, and cut my losses and not incur that 1% interest rate. As an alternative to that, you probably could set up a high interest bearing savings account, put all of that money in there, earn 1.75% on something that's costing you 1%, and have a rationale behind not actually paying it back early to the government. So then, this gives you that subtotal of the full amount you can expect to get forgiven based on all of your details. So now I want to describe some of the ins and outs of the reduction in headcount and reduction in wages pieces here. Okay, so the reduction in headcount draws the average FTE per month for the 8-week post-loan period, of course, from the estimated payroll calculation there, and it rounds it down. So basically 19 is what we have for our post-loan period anticipated FTE count. You're in a good place as long as this number is higher than at least one of the two numbers below it. So in this case, we have the two options here for the denominator, and this is calculated over on the FTEs tab. So with the FTEs tab, what we have here is the period of 1/1/2020 to 2/29/2020 has 60 days in it, which amount to 8.571 weeks. The hours to equal 1 FTE over a span of 8.571 weeks is 257.14. So this is simply now based on the facts that for 1 FTE they have to have worked 257.14, and the actual hours worked in my organization during that span of time was 5305. My total FTE count for 1/1/2020 to 2/29/2020 is 21. Using the same math on the period for 2/15/19 to 6/30/19, we have 135 days in that span, 19.285 weeks, 578.57 hours to equal 1 FTE. In my company or your company or whomever, this is a big number, but there was 10,653 hours worked. That comes out to 18 employees. And that carries over here into these two cells. And then this cell here in the combination of rows 12 and 13 will take the lesser of the two. And as long as this divided by this comes out to a number greater than 1, then you are good and you do not have a problem. But to the extent that your total number of average FTEs over the 8-week period is lower than both of the two numbers here, you then divide the average number of FTEs over the 8-week period by whatever your FTE count over the duration of time that you used here is, and then you will have a percentage not forgiven. So for instance, if my numbers were reversed here, then my unforgiven amount would be $10,121.05. Because of the fractional, the fact that 1 out of 19 is basically 5%, and so my FTE count comes in with a 5% drop. There is no threshold with the FTE count calculation. If you have any less number of FTEs at the end of the term or at the end of your loan period than you did on 2/15/2020, then you will not get 100% of the loan forgiven. And I'm going to say that again, okay? If you have any less number of FTEs as of the end of the 8-week period starting with the disbursement of your loan than you did on 2/15/2020, 100% of your loan will not be forgiven. However, if you have conducted a layoff and you hire back 30 employees on 6/30, then you will have met the obligation to restore your workforce, and therefore what would have otherwise been unforgiven is now forgiven. Now I still have a question that I'm doing research on, which is, okay, well, what about the situation where there's an individual who we don't hire back? How do we deal with that? Because the wage reduction piece is an employee by employee consideration. And again, leave it to our federal government to, on the spur of the moment, employ. They had to have employed a whole department of actuaries to come up with this crap. So anyway, reduction in wages, okay, is calculated on an employee by employee basis. It is not calculated on an average basis. So basically what you do here on the reduction in wages worksheet, and this again is why I say that there must have been a department of actuaries involved, because we're not basing this on average rates of pay per day, average rates of pay per week, average salary amounts, etc. We're basing this on the annualized amount that the employee earned in the full quarter prior to the disbursement of your loan, which is here recorded as $52,000 annualized. What this means is that we take the total wages earned in Q1, in essence, times 4 to come up with the annualized amount that represents. And then the annualized amount, and my spreadsheet right now does the math backwards here, but basically the actual annualized compensation rate paid during the 8-week post-loan period is the total compensation earned in the 8-week post-loan period divided by 8 times 52. And over here, that's what actually this does. This calculates. So basically what we do is we record here the annualized amount. So we take the amount that they earned over the 8-week period, divided by 8 times 52. We plug that value in these cells. And then here it will calculate your percentage decrease. If your percentage decrease exceeds 25%, then this column becomes yes, and that populates data into these columns over here to ultimately calculate the amount not forgiven. So in this context, we have to understand the amount not forgiven now is a function of the amount of the decrease that this person received beyond 25%. So you're not penalized on the whole wage reduction. That's why our number is so low. The amount not forgivable is only $230.77 because we've only exceeded the threshold by 2.8%. So this spreadsheet will calculate based on all of these details, will calculate for you the unforgivable amount if you do a wage reduction, and I need you guys to understand, even if there is a wage, no consideration that I'm aware of here at all for anything to do with the natural manner in which certain employees would have increases or decreases in their average compensation over the span of time. So you need to pay careful attention to whether or not it looks like you have a wage reduction problem. Again, keep in mind the fact that the threshold is 25%, should help you, help you with this. But any situation where it appears you have a wage reduction that is anywhere close to 25%, I think you're going to need to give serious consideration to that. So I suggest that you use a spreadsheet like this on a payroll by payroll basis to help you understand where things stand based on the actual results of each of the payrolls that are being processed. I am going to next week try to see if I can figure out a way to make this calculation happen automatically in Kronos. And if and when I'm able to achieve that, then everyone will be able to take advantage of having figured that out. For now, this spreadsheet at least gives you something to work with, something to help you anticipate the situation that you have ahead of you. So now, again, one of the things I want to point out is this last column, restored wages to rate payable on 2/15/20 by 6/30/20. So even if we have an amount not forgivable calculated, because we paid our employees significantly less than 75% of what they used to make, because for the first 6 weeks of the period, they were laid off. As long as you can say yes to this question, yes, this person has been brought back to their full pay by 6/30/20, then whatever you have in column G is irrelevant and does not have any impact on the forgivable nature of your PPP loan. So with all of that said, I'm going to take a breath. And now I'm going to talk to you about the headcount restore. So this is one place where I'm not sure that my spreadsheet is actually working quite right. And so I am going to send this to everybody as quickly as possible after this webinar, but I'm going to make sure that this section actually works right before I do. And what this is, what this should be calculating here is basically my FTE headcount. So this is a headcount, the restoration of headcount or wages, as opposed to the calculating FTE numbers for the purposes of calculating, determining whether or not we have, this reduction in headcount situation to deal with. This is for the determination of whether or not we restored our workforce, because if we restored our workforce, if we restored our headcount by June 30th, then whatever is calculated up here as far as the unforgivable amount is no longer unforgivable. And this spreadsheet will automatically zero out the unforgivable amount documented here based on if we indicate here that headcount was, if we indicate the job restored by June 30th, 2020, if I move that up to 10, then whatever amount of unforgivable loan had been calculated over here would have been zeroed out. But there will only be a number over here if my row 11, the average FTE per month for the 8-week period, is less than the number below it. In which case, as long as I restore by 6/30/20, which you can document down here, the spreadsheet will automatically calculate the full forgivable amount for you. It will be an accurate reflection of how much can be forgiven. Because again, if you restore all of your staff, then this is fully forgiven. If you restore all of their wages, this is fully forgiven. And that's what these last few rows down here are meant to do. And I just realized, having done that it is working because it's automatically changing from yes to no based on my data input. So with this all said, as you can see, my analysis here has one employee with wages reduced, which is decreasing my forgivable amount by 230.77. And then we also have the idle emergency grant recorded here, because if you did apply for and or receive an idle emergency grant, that will reduce dollar for dollar the forgivable amount of your PPP loan. Despite the fact that when you applied for it, it probably appeared to you, like it did to me, that was a freebie, that they were just giving you the 10 grand. I interpreted what they said to mean that the $10,000 would be forgiven inherently, not that it would be excluded from forgiveness when I applied for mine. But the nice thing is that as of yesterday morning, we actually had the $10,000 in the bank. So then we finally have our total amount to be forgiven, the percentage of the overall loan that represents, and then the amount of loan to pay back over 24 months. If it comes to that, if I decide not to spend that excess money. And again, keep in mind, it's bigger. The amount to pay back over 24 months, $60,694.88 is bigger than the amount of money I'd have to spend on my payroll to get to full forgiveness, because this number includes the $10,000 of the PPP loan or the idle grant. So with all that said, guys, I'm almost at the hour. What I want to do now is to go into Q&A. If I can find my webinar here. What is it? I can't do. Okay, there we go. All right, so now I would like to go into Q&A mode, and we need to deal with the fact that this is not very user friendly at all. Wow. Okay. Like I said, this is like the second time I've used GoToWebinar, and it is not very user friendly. Wow. That's crazy. Okay. I can't even see anything that anybody submitted. Let me see if I can get this out. Okay, thank God. All right, there we go. Just a little getting used to using the new program. Okay. Have you closed and received your PPP funds yet? So my loan is approved. It was approved on Friday. I have not received the funds yet, but the law says that I have to be funded within 10 days of approval, which would mean I have until Monday. So I should have all of my money by Monday. So the question read, FMLA leave expansion, emergency sick leave. The wording of the legislation states that the employee may also elect to use the paid leave provided under the Emergency Paid Sick Leave Act. Can you confirm if they can elect to use this at any time, or they must use up the ESPL-EE plus ESPL family first? So the rules, the DOL rules regarding the emergency paid sick leave are that you must allow the employee to pick and choose what bucket they draw from first in regard to emergency paid sick leave. It is not kosher or appropriate for you as the employer to dictate to the employee that they must drain any other type of time off bucket before they draw on emergency paid sick leave, whether that is for the employee or for their family. However, that is not how the FMLA works. With extended FMLA, you as the employer can pick and choose. You can decide. You can have a policy through which you mandate that all employees, before that they would be allowed to go on EFMLA, would have to drain 100% of all hours from all buckets, or 100% of time from their sick bucket, or whatever the case might be. You can dictate to the employee that they need to use other types of time off before they can use EFMLA, but you cannot dictate that they use anything before emergency paid sick leave. This is why I think the best practice solution would be to automate the application of paying emergency paid sick leave when they are out for legitimate emergency paid sick leave related reasons, rather than asking. There is no rule that says that you can't force them to use this time first. It simply says you can't force them to use other time first. So that's one way to create a hard and fast policy around this. But the number one thing to take away from this is you as the employer cannot dictate to the employee whether they use other accrued time before emergency paid sick leave. They need to be able to use emergency paid sick leave first. The reason for that is because if you did it otherwise, this benefit that they now are entitled to goes from now until 12/31/2020. Again, it has to be for the legitimate reasons that are related to the FFCRA types of time off, but it goes all the way through 12/31/2020. Conceivably, there might be an employee that would need to use their emergency paid sick leave, say in August or June, or even like September or December. And if you, when the employee goes to use their emergency paid sick leave later in the year, then step in and mandate that they draw from their time off buckets first, then the end of the year rolls around, FFCRA is expired, you no longer are on the hook to meet your obligation that you previously would have had to meet. This is why the rule exists that requires you to not tell the employee whether or not they can or they have to draw from another bucket before emergency paid sick leave. But again, for that reason, it also seems to make sense why it might be the right thing to do to automate and force employees to use emergency paid sick leave first. So then next item, can the PPP be used to pay the federally required 80 hours of leave for the FFCRA? That's a good question. I'm not aware of any rules that would disallow the use of your PPP money for the payment of, actually, no, hold that thought. I know all those rules. Yes, there's rules that prevent that. Because yes, no, you cannot do that. And the reason why you cannot do that is because all payments for FFCRA types of time off, you were going to get a tax credit for, and you'd be double dipping if you were using PPP loan money, which is meant to cover you for the cost of payroll, and you are also getting tax credits on the use of that PPP loan money. So no, you cannot use PPP loan money to fund the payment of wages associated with FFCRA types of time off. Do fees paid to Checkmate for preparation of weekly? that is a great question, Mark. It certainly would seem to make sense that they could be. That said, we are not included among the acceptable uses of PPP monies, unfortunately. I certainly think that that would have made sense to include here. I also think that it would have made sense for them to provide some consideration for payroll companies, so we wouldn't have to charge customers more for the services that we now have to expand and enhance in support of all of these new requirements. But at the same time, the straight answer to that is, as far as I know, you cannot use PPP loan money to pay check. I wish it were otherwise for that. but that is the reality as I understand it. So next, where is the SSS deferral form located? So Tina, we do have so out on the Checkmate website. We should have a link up there now, and I will make sure, Tina, that after this you get the emails, because you're probably not getting the emails, which is why you have that question. But it should be here under the COVID support page. And yeah, so what I'm going to do is I'm going to just make sure, rather than hunting and pecking here, I'm going to make sure that after this call, everybody gets an email link to the web form. Tina, I'll also make sure that you get added to our list of customers on the email distribution list, so that you're included in the future. We had an employee leave in January, included in our annual payroll documentation. The position was filled in March at a lower rate. Likewise, we replaced staff mid-year in 2019 at lower salary rate too. How does this factor in? Does this affect our loan forgiveness? Good questions. So again, the thing to keep in mind is that we have the reduction in wages is based on what they earned annualized in the prior calendar quarter, what they earned over the 8-week span, and you know, if there was a wage reduction that is not made up for by the end of the 8 weeks, then it is likely that you will have an unforgivable amount associated with the wage reduction. There is nothing that I have read or discovered in all of my research and investigation that actually has any reference to the position one was employed at previously versus where they were employed at now, and the justification of a lower hourly rate due to the change of a position. So I do not know that there's any accommodation for you there. I suspect that you are going to be potentially subject to a portion of the loan that won't be forgiven. Again, you know, one of the things to think about, guys, when we're talking about this too, is worst case, best case scenarios. So rather than, you know, getting ourselves all hung up on, you know, an unforgivable amount and gee, that sucks, yada yada yada, and on top of everything else that you have to worry about, you know, so from my perspective, again, the way I look at this is, even if I couldn't get a dime of my loan forgiven, I still would do it. I would still take in the money, and I would still pay back the loan over the 2-year period, because I could put that money in a high interest savings account that would earn more money for me than the interest I'm paying on it. So the worst case scenario here is still going to make sense for you to pursue this. But I do believe that based on what I know right now, that situation would result in an amount of your loan that would not be forgivable. Then likewise, we replaced staff mid-year in 2019 at lower salary rate too. So that one doesn't really, so the 2019 situation would have affected the amount of the PPP loan that you would qualify for, because you probably used the calendar year 2019 to calculate your average monthly payroll costs. But the rate of pay that you paid somebody mid-year in 2019 will have absolutely nothing to do with, unless that was the last quarter in which you paid them, would have nothing to do with whether or not the loan can be forgivable. Now, if it was an employee, because the rules say that for the purposes of calculating a wage reduction, you have to take the last annualized or the last full quarter during which they received pay and annualize that pay amount to come up with how much they previously were making. And then you annualize the 8 weeks to come up with how much they were making currently. And so the if it is the case that one of these people who you reduce their salary down to in 2019, if that was the last quarter they worked, and then you rehired them to work after February 15th, and the rate of pay that you hired them to work at was lower than what they were making, in the second or third quarter of last year, whenever their last full quarter of pay was, then by all appearances, you would have a portion of your loan not forgiven. It doesn't seem to make sense to me that we would penalize you for a situation like that. However, I know of no rules that would prevent you from being penalized like that. So again, from the perspective of thinking about this in a worst case scenario, based on all of the language of the rules that I know about, and the fact that you're supposed to look at the last full calendar quarter during which the person was paid, it would be a situation where again, there's a lot of what ifs here. Well, what if it's somebody that we hired back who's been unemployed, who we didn't have on our payroll for 10 years? Do we still look back at the last calendar quarter that they received wages 10 years ago? No, I think what's going to happen here is when it comes to that kind of situation, there will be some clarity added eventually, hopefully sooner than later, on the duration of time that would transpire before they are considered a terminated individual, thereby making their the next time or when you paid them between February 15 and 6/30, that would be considered payment of wages to a new employee. But I haven't seen the rules around that. I can only speculate that they will be there because it only makes sense. So if somebody earns more than 100,000 on an annualized basis, less than 100,000 annualized with each pay period, gets a bonus in late December, bringing this person over 100,000. Is that a problem? So, well, first of all, when you applied for your PPP loan, you wouldn't have been able to consider the amount that they earned over 100,000 for that year in your analysis. And again, the idea here with your annualized compensation rate for Q1 2020 or whatever period you're going to go back to do this assessment, if my spreadsheet looks like this, this does appear to be a problem, but it isn't really, because where this says 150. Your annualized compensation rate for this analysis caps out at 100,000. So the bonus, even if that period of time happens to be, again, as I said before, this is not designed to penalize you for reducing the pay for people that make over 100,000, as long as you don't reduce it down below 75. But if you reduce it down to 74, then you have a problem. So for the person who earned a bonus at the end of the year that brought them over the 100,000, if that December is included in your annualized compensation rate consideration here, which would mean that that person did not get paid in Q1, because if they got paid in Q1, then you would use Q1. But any way you look at it, whether you use that December period or you use Q1, the annualized compensation rate here caps out at 100,000. They don't care if you decrease somebody who makes 300K a year by 200%, or by 75% or whatever. As long as you don't bring them down below $75,000. We made the spreadsheet larger. I wish I had seen that earlier. Sorry, but I will be sharing the spreadsheet with everybody, so you will be able to see things better. And if there's any follow-up, help that anybody needs because they weren't able to see the spreadsheet during the presentation, then I'm happy to have that conversation directly. Is dental insurance considered health insurance? Yes. Health insurance includes health, dental, vision. Is retirement cap at 100,000? No. So this is a good question. The annualized compensation. So for instance, for anybody that makes over $100,000 of gross payroll costs annualized, you cannot pay them during your 8-week loan period more than $16,666.67 and have that be forgiven any amount that you pay in gross payroll costs to an individual that earns over $100,000 in salary If they earn over $16,666.67 over the 8-week span from the point of disbursement of the loan through the next 8 weeks, then any amount that they earn over $16,666.67 is not forgivable when it's the gross payroll that we're talking about. When we are talking about, so this is not considering, you are not considering the employer contribution to the retirement plan. You're not considering the health insurance costs, et cetera. All of those costs can be considered in addition to the $100,000 compensation. So, so for instance, if we have, let's just say that we plan, we have $40,000 of excess PPP money, and we're going to fund our retirement plan with that money. And we have somebody who's earning $16,666.67 over the 8 weeks, we can fund their retirement account with $10,000 of our $40,000 if we wanted to, and we will not be violating the rules in any way, shape, or form. There are no rules around anything to do with how much the employer spends on retirement or health insurance for that matter. And those numbers are in addition to the compensation, the $100,000 compensation, not inclusive of. The other thing I want to say is that to the extent that you have people who are making over $100,000 a year, what this really means is that you need to fund that part of your payroll through another source, not through your PPP loan. So my suggestion to everyone is that you set up a bank account, an exclusive bank account that is going to hold only your PPP money. Okay. And then my other suggestion, I'm not suggesting that you would necessarily have us change the bank account that we use to draw your payroll funds from, but what you would do is you would use that bank account, and every time we finalize payroll, you would fund whatever bank accounts that we draw payroll funds from your PPP loan account, and therefore, every transaction that comes out of your PPP loan account would be only in support of legitimate transactions that can be forgiven, as long as all of the other variables at play here allow you to get 100% forgiveness. So what I mean by that is, if we hold all your PPP loan money in a separate bank account and you move the money into your operating account or your payroll account every time we process payroll, then what you would then do is you would either you wouldn't move the money that represents the gross payroll over 100,000 for those folks who are making over 100,000. Either that would come out of the operating account if that's the account we're drawing from anyway, or you would need to move money from your operating account into the payroll account to make up for the wages that are in excess of the PPP loan money. I think this will be the best case scenario because that will put you in a position where you can prove to your lender that every transaction that came out of your PPP loan account was a legitimate transaction related to payroll or a legitimate transaction related to the payment of utilities, rent, etc. Whether you draw payments on utilities, rent, etc. from your PPP loan account or from your operating account, I think is a decision for you to make on what makes the most sense for you. I do, the clarity you would want to provide your lender will be there, even if you make those payments directly to, your landlord or your, the health insurance company or the retirement account, things like that from the PPP account. But you might decide, you know what, we're just gonna move in one fell swoop the total amount of gross payroll plus tax liability out of the PPP loan account, aside from those wages in excess of 100,000, and we're gonna move that into the account that Checkmate draws from in one fell swoop. Just to settle that, and then we'll provide a bank statement to the lender along with some payroll reports to prove to them that every transaction that came out of that bank account actually was used to fund payroll or one of your utility or other legitimate expenses. So let me see. If we increase independent contractors, could their pay be forgiven? No. To my knowledge, independent contractor pay cannot be forgiven. Because they themselves should have been able to get their own PPP loan through which they would be able to fund their own payroll when you are not in a position to do that. So I do not believe that that is something that you can expect to have forgiven. I'm very, very confident about that. What if the stay-at-home order goes? I know. So yes. So Deb, this is a very good question. So the question is, what if the stay-at-home order goes beyond the May 4th date, and employees are better off collecting unemployment than coming back to work, or are unable to come back to work? Will the 8 weeks be extended? Good question. There's two potential things that I am hoping to see change. But at this point, I can't. I wish I could tell you that things that are logical would be reasonable for us to expect, but I can't do that. Two things that I'm thinking we might see change. One is I think that we might see the 6/30/2020 date change and be extended. But the fact of the matter is that this is federal legislation, and the federal government has not issued any stay-at-home orders. So the stay-at-home order that we're talking about is the New Hampshire stay-at-home order, which was issued by Governor Sununu. And the the federal legislation, of course, is not taking into account anything to do with what's happening at the state level here. And again, for all of that, for all those reasons, it doesn't make sense for 6/30/2020 to actually be a hard and fast deadline for us, because in all likelihood, it's probably going to be the case that is extended. And if that's extended, if we are now venturing in, I mean, if you're able to open up shop again on the 1st of May, you barely have 8 weeks to spend your money. And right now, as far as I understand it, and again, it's contradicted by the rules within the law itself, but as far as I understand it, if you get your loan approved and you get your money on May 1st, as far as I understand it, I mean, rather on June 1st, that gives you 4 weeks to spend it, not 8. As far as I understand it. Now, it may be the case that they're going to loosen up the rules on this, and they're going to say that you'll at least have from the point of funding through 8 weeks. But then that still doesn't change your scenario, because you're probably already, either about to or already have a PPP loan approved, which means that your 8 weeks has already started. So I think that we might see some additional guidance come out that say that the 8 weeks will start either on the day that you receive the funding of your loan, or the day on which the local state order that has shut down your company is lifted. I hope that they change it to say that. The other thing that I'm hoping they change, for the sake of hospitality customers and others that have a lot of facilities and other upkeep, is the 25% rule. I think that the 25% rule seems a bit constricted for those folks that have have had to shut down your whole operation, and now you're sitting on $20,000 of rent a month or something like that. It seems to me like there's a very legitimate reason why it would make sense for us to allow employers to spend more than 25% of the loan money on non-payroll costs. But again, I'm keeping my eyes on this. I will report back to everyone as soon as I hear any word on changes to these things or anything else for that matter. You mentioned if you have an employee earning in excess of 100,000, say 250K, you can reduce his funds during the period as long as you don't go down below 75K. So if that person actually draws only 60K annualized, you would have to bump him up? And yes, that is yes. If you have somebody who only earns 60,000, who previously was earning, as of 2/15, or rather as of the prior quarter, the annualized compensation rate of more than 100,000, or in your case more than 90,000, and they during the 8 week span earn an annualized salary amount of 60,000, you will have some of that loan not forgiven because of the wage reduction that you did not restore back to the prior level. And again, this has no consideration for what job they're performing. There may be a very legitimate reason why this person is earning significantly less money than they did before, but there's no consideration for that in the legislation that I know that. Permit-clean webinar, 8 weeks is from date of loan. Right, exactly. 8 weeks is from the date that the loan is basically the date that the loan is dispersed. So the date that the loan is in your bank account. Are equipment lease payment forgiven under the PPP or only real estate leases? So that is a good question, because the rules very clearly say that you can, hold on one second. So let's see, you can use them, payments on interest on any mortgage obligation, which shall not include any prepayment or payment of principal on the mortgage obligation. So basically your interest expense on the mortgage, your rent under, including rent under a lease agreement. Because we specified for rent, including rent under a lease agreement, and there is no other reference to any costs associated with leased equipment. I'm assuming that this means that we cannot use the loan proceeds to fund any costs associated with leased equipment unless we could justify calling such leased equipment a utility. And I don't know off the top of my head what the definition of a utility is in the context of this legislation, but that is certainly worth looking into. And I will do a little bit of looking into that here to see if I can't come up with some good good knowledge to share with you on that. Are distributions to the owner or of a single member LLC allowable? No. Distributions to an owner of a single member LLC are not allowable to use for PPP loan proceeds. So for instance, likewise, not just distributions to a owner of a single member LLC, but the proceeds that are or compensation in the form of a disbursement to a S corp shareholder or other owner of any business are not included as PPP in the PPP loan money. The one question I have is I am going to look into that because a single member LLC who's the owner of the company who has been previously, let me think this through, has been previously funding their own pay, but cannot obviously be on payroll. And this is a dividend that they're earning, the distribution. I'm going to look into that to confirm. I don't believe that you can include them in the PPP, for forgiveness purposes. I am going to research that. I will, include this in one of my updates to all customers coming up as a detail to share with you once I know the answer. My answer right now is I do not believe you can do that. And that is the last of our questions, I think, for right now. So with all that said, guys, I'm very happy that I've been able to, share a lot of knowledge with you guys. I'm sure your heads are spinning. I am going to send a copy of the PowerPoint and the spreadsheet. In this case, it will be sent in an email to everyone on the call. We will also post it on the website so that you can access it there, and any customer could access it there. We'll send you a follow-up email tomorrow. I will try to answer some of the questions I did not answer this afternoon in that email that I send you tomorrow. You will have the PowerPoint and the spreadsheet tomorrow. And I hope this was useful and beneficial for everybody. If anybody has any feedback or insights on other things that you might like for me to cover in an upcoming webinar, I'm always open to ideas. Given the amount of valuable information I've been able to share here, I am planning to continue doing at least one, if not two, webinars a week for the foreseeable future. Next Wednesday is going to be a webinar the return to normalcy and what we need to do to prepare our workplace for future, coronavirus prevention measures, things of that nature. So that will be happening next Wednesday at noontime. And I hope everybody has a great afternoon. Let me know if you have any other questions, and I'll do my best to make sure either I or someone on my team gets back to you. So everyone have a good afternoon. Take care and stay healthy. I won't put me in there.